hope you're doing well. So today, I want to talk about stonks. I know I'm always talking about stonks, but today we're going to talk about stonks. For the longest time, I have been meaning to do more videos about stonks, which is the stock market, for those of you who are not familiar with the memes going around. And I have a lot of ideas for possible videos, but I really just want to get people started. And so, like, instead of taking the time to write it all out, and do a little bit of extra research, because there are some questions that I don't know the answer to, I figured I'd give my quick start guide for anybody who's interested in getting into the stock market, but isn't really sure what to be, and maybe doesn't have a very high tolerance for risk. So this is the advice I give people, pretty much anybody, that want to get investing, don't really know how or what they're doing. It's very simple. It's historically, statistically pretty low risk, which means you're not going to get rich quick. This is a long-term game. Warren Buffett said, it's not about timing the market, it's about time in the market. And what he means by that is, the more time you have, so especially if you're young, if you're, 20s, early 30s, the sooner you get started, the better. You'll have more time in the market because historically stocks grow about 8%. This is on a long enough timeline, averaged out, it's about 8%. Some years it's negative, some years it's like positive 15. It just depends. But it tends to go up. If you look at pretty much any stock that's been around for a long time, you just check it and it tends to go like that, right? So that's why the joke, stocks only go up, is a popular meme. So that said, obviously, I know a little bit more than a lot of people. I'm not an expert. I will answer any of your questions. I'm not trying to make money off of you. So I think legally I have to say, like, this is not financial advice, because I'm not trying to get anything out of you other than I'm trying to teach you how to get into the stock market and hopefully get your finances in order for your long-term financial health. That would make me very happy. The more people I can get doing that, because so few people, well, I'm not gonna say so few people, well, yeah, so few people are adequately funded for where they should be in life. I know I am not, and I had a very good week this last week, which definitely changed the trajectory quite a bit, but that is not common. So the more people I can get on board, figuring their stuff out, that makes me happy, right? So let's figure this out. So there's a couple steps you're going to want to do, and I'm going to try to make this as simple and as easy as possible. The first thing you want to do is you want to find a broker that you can go through. This is like E-Trade, Fidelity, Robinhood, Webull. There's a lot of them out there. I, up until recently, was using Ally, which I do not recommend them, especially if you're a beginner. Their website is very complicated and it had a very big error. So I'm taking my account away from them as soon as I can. Robinhood, which is getting a lot of heat right now for some things, but it's not really their fault. If you really want to get into the nitty-gritty about that, I can talk about that. But really, Robinhood is great because it's very simple, it's very easy to use, it's very user-friendly. There's a lot of things to like about it. I've tried those two and TD Ameritrade a couple years ago, and I didn't like TD Ameritrade either. So, I'm not an expert. Try them yourself, see what the user interface looks like. Do you like it? Does it make sense to you? Can you find what you need to do? If so, great, link up your bank account, throw some money into it. But there is one thing you want your brokerage to do, and this is very important, especially if you are starting with not a lot of money. This is, if you have $5 to invest, this is what I would suggest, is go with Robinhood, because I know they have this functionality. It's called partial shares, which is a newer thing. Basically, you could say, I have $5. I want to buy some of the share that costs much more than $5. And they'll say, okay, we'll sell you a fraction of the share. Different brokers might have different names for it, but this is the big key. If you don't have a lot of money, you want to get started. So I know Robinhood does this, so that gets my vote. I know how to use it. I can answer some questions if you have them about it. I know there's also like a referral thing. You can give people your code and you both get free stock. I don't know how that works. I'm not trying to get anything out of you. I just want you to invest your money. So I'm not going to give you my code. I'm not going to pressure you to use Robinhood. This was not sponsored by Robinhood. I just think it's very easy. Everybody I've shown it thinks it's very easy. So give it a shot. I don't know. Try a couple of them, see what you like. But Robinhood would be my suggestion. So that's the first step. The second step is pick an amount of money you can afford. I know you're probably like, none. Which is, man, that's how it goes. But even if it's $5, you save $5 a week. And then every week on Monday or Sunday or whatever, pick your day, the stock day, what you're going to do. It needs to be Monday through Friday. So I guess it can't be Sunday. Monday through Friday from it's 9:30 to 4:30 Eastern time. So figure that out. That's when the markets are open. But basically what you want to do is you want to take your $5, if that's what you can afford every week. That's the big thing of like, oh, well, if they just didn't drink coffee, and save the money. The part they're leaving out is you need to take the money you save from not buying a coffee and put it in the stock market instead. And with partial shares, you can do that. So, pick your day, Monday morning, when you get to work, put your $5 in, and what you're going to do is you're going to buy shares of what are called ETFs. That is electronically traded funds. Now, what these essentially are, they are organizations that take in money and they buy a lot of stock with it. They buy different stocks, different markets. There's a lot of them out there, and they all buy different things. Usually the name kind of gives away what it is they're doing. I'm going to give you a couple suggestions here for ones to look at. Do your own due diligence, kind of figure out, but regardless, if you pick pretty much any ETF, you should be fairly safe. But if you want to be extra safe, what I would recommend are international market ETFs. These are funds that will go all over the world in different markets. They're buying stock everywhere. Okay, so even if one market goes down, if another one's having a good year, it'll balance out. So it's as diversified as you can possibly get. Okay, so there's a couple I have for you there. Hold on. Oh, excuse me. Okay, so and full disclosure, I do not own any of these. These next three, VTI, VXUS, and VWO are 3 international ETFs. Take a look at them, see what you think, look at the long-term thing, and then if you like them, every week on that Monday, you throw $5 in at them, and over time, your shares should grow. Sometimes it'll be down, sometimes it'll be way up. Just try not to think about it too much. You look at it once a week. These shouldn't move very much, They'll kind of stay within a pretty narrow bandwidth. So those are really good ones. If you want to step up your risk a little more, you can go specifically with American market ETFs. And I have a couple shares. I think I want to say 15 total shares of one called SPHD, which isn't that expensive. I like that one because it's indexing the highest dividend paying, lowest volatility companies in the S&P 500. So again, it's pretty safe. It pays dividends, which if you're not familiar, dividends are profits paid to shareholders as cash. So every 3 months, you'll get a little bit of money for every share you hold. I think it's probably less than 10 cents a share on that particular stock. Some stocks is a lot higher. It just depends on the stock and what's called the dividend yield. That's something you don't really need to worry about. Some ETFs will pay dividends, which is great. I love dividends because it feels like free money. And you can just reinvest that right back in, or you can pull that out and go buy yourself some ice cream and be like, look at me, I'm on Wall Street mogul buying ice cream. So the U.S. market ETFs I like are SPHD, VYM, and VOO, and also VGT, which is a tech one. But I only own SPHD. The rest of these, they're pretty good. Take a look at them, see what you think. Is it for you? Pretty much any of these that I've listed should be relatively safe. Again, I don't have a crystal ball. I don't know what's going to happen. The market can melt down the day after you put your money in, and you might lose your $5 or whatever you feel safe putting in. So, as you should understand, don't put money in you can't afford to lose. Do not take out credit debt, because you're not going to be able to make more than you have to pay in interest fees. So that's silly. If you have debt, your $5 might be better spent putting towards that, especially if you have high interest rates. Because think of it like this: if you put that $5 into your 30% credit card, 30% interest, that's an instant 30% win. That's very hard to get on the market. So pay off your high debt first. If the APR, the annual percentage rate of a debt, is more than like 5%, it's probably better to put your money into that instead. So there's that. Also, there's risk involved, obviously, but there is risk involved to everything. So, I can't tell you you're not going to lose money. I can't tell you you're going to make money. I can't, none of that. But at the same time, I can't tell you that if you get in the shower, you will not slip and fall and hurt yourself. I cannot tell you that if you get in a car, you will safely make it to your destination. There is risk to everything in life, and we just have to make bets. Everything we do is a bet. We don't really think about a lot of things like that, like getting in your car. Super risky if you're being real with yourself. So think about that. If you're kind of scared of it, just you might be scared and thinking like, oh well, I might lose money. I'm scared of it. I don't want to put money into it because I don't want to lose money. Here's the thing. Doing that is still a bet. You are betting that you will now make enough money and that the healthcare system will be fine by the time 20 years from now when you need the money to pay your healthcare costs. So consider that. Not making a move is still making a move. So either way, you're still playing the game. So why not take statistically the better bet and let your money work for you? And the more time, the more money you can put in, statistically, historically, the more you should be able to take out at the end of the tunnel. So that's my advice. If you have questions, I will do my best to answer them. I'm not obviously an expert. I know a little more than most people, but I don't know a ton. If you want advice on specific stocks, the answer is I don't know. Maybe. No one knows. If you want something a little more risky than that, I could talk to you all day about potential options. Those will be future videos, but this is more of kind of just a quick start guide. If you want something more risky, if you have an appetite for risk, I would say my advice, which is I think undervalued at this point, is to go buy collectibles, Magic the Gathering, Pokemon cards, Legos. You buy some of those, because if you go look on eBay, what some of this stuff goes for, stuff, Pokemon cards from 20 years ago now go for thousands of dollars. So if you can go get Pokemon cards, you could seal them up somehow in a very safe case, hold them for 10 years. Maybe the trend comes back 10 years from now and it's a big deal and you can make a bunch of money off of it. Same with, Legos have a little more staying power, it feels like. But I've seen sets go for, thousands of dollars that would have retailed for 10 or 15 bucks. So, I think that's probably the best way to get a ridiculous return if you have tons of time. And it's also kind of just like a weird thing, but you have to have somewhere to store them, so the risk is higher. I don't know. If you ask me what I think about cryptocurrency, I don't believe in it. I feel like the whole thing is a pump and dump scheme for chumps. So if you like crypto, sorry about it. I don't understand it. It's not linked to anything. To me, it's the same as if you're just holding on to dollars hoping they appreciate. Like, forex trading, which is a foreign exchange where you say like, oh, I think that the dollar is going to go up, so I'm going to hold a bunch of dollars, and I'm going to hold a bunch of Deutschmarks, which is the German dollar. You know, I don't even know if they use that. I think they might be on the euro now. But again, I don't follow that market. I don't understand it. So that's the other advice I have. Narrow your focus so you understand things. And if someone's trying to sell you on something that you don't understand, don't buy it. Okay? That's it. You need to be logical. The reason why a lot of people lose money in the stock market is because they get sold on something, or because they get emotional, or they let greed get the better of them. Like, this stock is going up. Okay, if it's going up, start pulling some out. That's called profit taking. You want to do that so that way you're not left bag holding when it goes back down. Okay? Also, buy the dip, but don't catch a falling knife. See how stocks, they make this confusing on purpose. But if you see, a share of stock that you like a lot, you know a lot about, if it's gone down, like, for example, I have followed Coca-Cola for a long time, which is the stock symbol KO. I have I want to say 60 shares of it right now. Right now it's trading under $50, which in the time I've owned it, it hasn't done that before. So it's like, okay, that's kind of weird. Like, this might be a good time to buy it. Again, not financial advice. I own it, so I can't, go buy it. Oh, it's so amazing. Which, I don't know how these rules are with market manipulation. I don't think enough people watch my channel for me to be market manipulating, but if the SEC is watching, I'm trying my best to not. My intentions are good. I just want people to go invest in some ETFs, buy it, hold it till you need it when you're 40, 50, 60, whenever, And that's what I tell anybody who's scared of the market, wants to get into it, but maybe needs a little bit of advice. So there you have it. If you have questions about basics, give me a shout. If you have questions about brokers, I probably can't answer them, unfortunately, because I've only ever used 3, but soon to be 4. I don't know what my next one's going to be. I'm going to be auditing them all here pretty soon, because I'm really angry at Ally. Robinhood has been okay, but if I could get everything onto one platform, that might be better, because what I was doing was having 2 brokerages, one for my risky plays and one for my safe plays, and that way the money stays separate and I never get too emotional to start throwing it. There's extra steps to throw the money over to the risky side, and when there's extra steps involved, I know my lazy monkey brain is going to be like, it's too much work. So that's why I do it that way. If you're just getting started, don't worry about risky plays, or it's your decision. You can go lose all your money quickly. Another thing I would say, okay, hold on. If you're excited about big money, get rich quick scheme, I'm gonna be a stock trader, do kind of what I suggested. Put your money in the safe stuff, and then do what's called paper trading, which is simulations, which there's tons of simulators out there where you can play with fake money and you can get your jollies that way. And once you've lost your first $1 million in the paper trading, then you can go take whatever you've actually earned and start making those slightly riskier plays. So there you have it. That's my quick start guide to investing. If you're spooked by investing, and you only have a couple bucks to invest, it doesn't have to be scary. It's only as complicated as you want to make it. Just get your money in the market, let it work for you, so that way you can start pulling yourself up out of, if you're in the bottom, you're in poverty. If you can commit to $5 a week, if you can find a way to make, work that extra shift to get a couple extra dollars, that's my advice. Hold it long term, and just treat it like a bill. Just be consistent. The more time you have it, the better off you'll be.